Hello and welcome to the latest installment of our Convergent video series. Today we're going to be doing our February investment themes, where we're going to cover a look back into January and what we saw in the markets in January, as well as what we saw on all the economic data and some recent events that happened just in the last week or so with the Fed announcement on their recent rate increase, as well as the jobs report from the last Friday. So I'm looking forward to sharing all this with you and at least giving an opinion from our view on what all this means. So I'm going to jump in, and we're going to start with the January market review. And it was quite a January. And, I would say from our point of view, a little bit unexpected how strong the market was. And in our view, what we really are seeing is a lot of the market participants believing that the Fed was going to have to be in a position to pivot because the economic data was beginning to get challenging. And so what we kept seeing throughout the month is really steady flows into the markets. And we saw very, very large positive returns, both in the NASDAQ and in the Russell 2000, with slightly lower returns in both the S&P and the Russell 2000. But overall, a pretty fantastic month for equities overall. We also saw that in a lot of world equities as well, with emerging markets and world equities overall, both finishing well over 7% to the positive for the month of January. One of the laggards, partly as we begin to see inflation tail off, commodities have tailed off, and really tailed off early in the month, although they did get a reasonable rebound later in the month. And we'll talk about where we see some of these commodity prices heading in the near future. It was also a very good month for most of the precious metals. And so we saw copper, gold do extremely well in January. Silver was a little bit of the laggard through the month, but really saw strong returns in gold, which had been had a really solid return early in the year last year, but then really lagged the markets in the second half of the year. And so typically gold does better in a falling rate environment. And so we saw that positive outcome in January. And we are starting to see some return to performance in bond markets as longer term rates have continued to fall. We've seen longer term treasuries perform much better. So the 20-year treasury was up over 7% on the month, with the aggregate bond index up over 3%. On the short end, though, still challenged, because while longer term rates have begun to come down, with the Fed continuing their tightening cycle, short term rates have remained elevated. So we're not seeing the same type of performance in the short term bonds as we're seeing in longer term bonds. And here's evidence. One of the main interest rate indicators people follow is the 10-year treasury. And we saw it fall from the upper threes, near 3.8 to start the month, and come down all the way to about 3.5% by the end of the month. We have seen a bit of a spike here as we jump into February, but still overall a large drop in the 10-year treasury, which feeds into other things like mortgage interest rates, which have also started to come down. So how about from an economic front? I'm going to jump right into something that happened right actually at the very beginning of February, but it was related to what we talked about earlier with the market going up so much, is that everybody was expecting the Fed to pivot and indicate that they were planning to either slow down the rate of increases or perhaps even take a pause overall, because we were starting to see negative economic data, as well as a decrease in inflation. And for the most part, I think in the interview with Chairman Powell after their announcement that they increased rates 25 basis points or 0.25%, people got what they were looking for, and they got a more dovish commentary than they've gotten recently from the Fed, and the markets raced higher for a couple of days. And so, really, I think people are anticipating the Fed is going to have to slow down. But when you think about it, if the Fed is having to pause the rate in which they're increasing rates, or maybe even pause rate increases overall, the reason they're doing that is because they're starting to see challenging economic data coming through, which isn't good for the economy. So their hope is, and I think many people who are counting on this Fed pivot, is their hope is they can slow down the pace or even start to lower rates fast enough to really avoid a hard landing and really create the soft landing that people have been talking about since they started raising rates. And what maybe, is throwing some, fuel into the fire of not being able to do that, though, is on Friday of last week, we got the jobs report, and it was a massive surprise to the upside of much more jobs being created. So one of the main areas that the Fed is watching in terms of whether their policy is working is on the labor market. And we continue to see an extremely tight labor market, extremely strong jobs market. And we saw over 500,000 new jobs created in January. The expectation is only around 180,000 jobs or so. So a big upside miss on the expectations. And we saw the market, react negatively to that news, believing that, well, maybe this pivot really isn't in the cards if the labor market continues to be as strong as we're seeing. So some of the other indicators, though, so there's a lot, as we're starting to see the data come out over the last couple of months, there's a lot of mixed data. So while we are seeing still very strong hiring, we are starting to see at least a slowing of the rate of growth of wages, where it's now down in the 4% range on the wage growth versus well over 5% last year in regular steady wage growth. So we are starting to see some slowing on the wage growth side of things. But other areas we're starting to see maybe a little bit of stress. We'll have to keep an eye on this going forward. But we did see the price of gas begin to move back up again in January, and actually is increasing at a bit faster of a pace even than we saw at the beginning of last year. So we'll have to keep an eye on gas as well as oil. So we've now seen the Strategic Petroleum Reserve has been reduced significantly over the last 6 to 9 months in reaction to higher oil prices. And while that's helped reduce the overall price of oil in that time, it's putting the stock of reserves, what we have left in reserves, at very low levels and historically low levels, which does put some level at a point where we're not going to continue to see this drop in the SPR, which means we're likely to see less supply on the market, which then could impact prices as well. And we did see, while initially a drop in oil prices in January, throughout the rest of the month, we saw a steady, relatively steady increase and finished the month slightly above where we started. So while, overall inflation is seemingly slowly coming down, there is a risk that if we all of a sudden have some supply issues with oil or gas, we could see some spikes in prices in those in the coming months. In terms of other economic indicators, we're keeping a close eye on, and sometimes this can be lagging indicators, but we do expect to see continued decreases in overall earnings, so negative earnings here in the first quarter of 2023, as well as the second quarter of 2023. So we expect 2 more quarters of reported earnings decline. And while we did see some challenging market returns in December, basically as companies have reported their earnings so far in January, we have seen an overall negative trend on earnings and even lower guidance going forward. But so far, because of the Fed pivot, or the potential for the Fed pivot, this has mostly been ignored by the market. So we'll see how this might play out in the coming months. So a couple other final things, looking at where we see things headed with inflation. So we do, again, continue to see that inflation will come down in the coming quarters, and expect that Q1 inflation will be closer to 6%. And by the time we get to the end of Q2, we're going to see inflation in the low 4s. But we are still expecting to see inflation remain stickier than many people are wanting or expecting to see. And then even at low 4% year over year, quarter over quarter inflation, that still creates challenges in the overall economy, and it's much higher than we've experienced in recent years. So something to keep an eye on. And if there's any spike in commodity prices, as people do believe the Fed will pivot, which could lead to an increase in demand and prices on commodities, we could see these numbers begin to creep back up again. One last area of concern that we want to keep an eye on is GDP. And as we look to the quarters ahead, we're actually expecting to see negative quarter over quarter growth in the economy. And historically, when you've seen falling inflation along with falling growth in GDP, that typically is not a good environment for equities. Again, there's always, mitigating circumstances, and there's always exceptions to the rule, but historically that's what we've seen. So while we have seen, again, significant increases in prices in the first month of the year, we're going to keep close eye on it. And if the economic data begins to turn more positive and the Fed remains steadfast in the fact that they may not continue to raise rates, then we're likely to see equities bounce significantly in the first half of the year. If, however, we see continued strong jobs data and we start to see inflation creep back up again, the likelihood is the Fed will have to either continue raising rates or at least commit to holding them steady for a much longer period of time, which could create a lot more downside volatility. So a lot of chop is really what we're expecting for this year. So we may see months like January and then see months where we see more like December, where the market was down significantly, and just see that chop back and forth for much of the year. So we're going to stay on our toes and stay nimble and keep an eye on everything, and obviously keep you informed of what we're thinking and what that we think that might mean for how we should be investing in your portfolio. So with that, appreciate your time watching this video. And if you, as always, if you have any questions on what we're seeing and how it might be impacting your portfolio, please do not hesitate to reach out. We'd love to talk with you about that, and look forward to speaking with all of you at some point here in the very near future. Thank you.